Hi everyone, welcome to today's video. So let me start today's video by saying that the data that I'm going to show you today, it is scary, you might not like it, and it might make you lose faith on the stock market for the next couple of years. But this is a very important video, so please watch it closely. Make notes, do follow up reading on the things that I'm stating in the description box. So with that said, let me start our discussion by showing you two specific charts. This is chart number 1. This is regarding S&P 500, which represents the US stock market. And in the last 30 days, it has fallen by roughly 9%, which is a fairly big fall. Now, chart number 2 is regarding Nifty 50. In the last 1 month, Nifty 50 has roughly fallen by 2 to 3%. So now the natural question comes that since the Indian stock markets closely mimic or mirror the US stock market, is the Indian Nifty 50 going to fall more? Because I'm an Indian stock investor and it is going to create a carnage for me on my portfolio. So should I be scared? Should I not be scared? Let me do a very quick technical analysis and give my verdict. Then I will do a fundamental analysis. So let us look at the top of S&P 500. This is the index of US and the bottom to which it has fallen. So it has fallen from its top by roughly 14% in total. Now let us do the same exercise for Nifty 50 also. So here is the top. And if you take a look at the last trading day, it has fallen by only 8%. So 6% fall more to go. And if you corroborate this data with the first two graphs that I show you, it fits perfectly. So if we go with the assumption that the Indian market and the US market has an exact same correlation, then the Indian markets from this point should fall by roughly 6%. So we should be trading somewhere here, right? Which gives us a Nifty level of roughly 16,000. Is that going to happen? My bet is yes, it is going to happen. Is it going to happen tomorrow? No one can say for sure. My bet on that would be a no, because majority of the people are expecting the markets to fall tomorrow. So according to me, that should not happen tomorrow itself, but it is likely to happen subsequently. Now, why is that going to happen? So for us to analyze that, we need to understand why is it that the US market fell quite sharply on the last trading day. So there were two primary reasons for this. The first and foremost primary reason was the fact that the Fed expectation of inflation has been haywire. They expected inflation not to go so much, but the inflation data in the US has been really wacky. It has been going up at a very fast pace. So the US Fed committee is going to meet in the first week of May. So just a few days from now, they are going to meet, and it is expected that they are going to increase the interest rate very, very sharply. So what happens when the interest rate is increased in the economy? Simply the flow of the money that is flowing in the economy, that comes down. Why does that happen? We don't need to understand the entire macroeconomics behind it, but you simply need to remember the point that whenever the interest rates are hiked, the total flow of the money that is flowing through the economy, it just shrinks. So that kind of creates an impact or a negative impact on the economy. And that is what people are expecting. And this is the first key reason that the markets fell sharply, quite aggressively on the last trading day in the US. So this is something that all of us knew. I have also been speaking. So what's new about it? Which brings us to a second and a more worrisome factor, that we are moving towards something called as stagflation. So let me take some time to explain what stagflation is, and it is critical that you understand how this stagflation game is going to unfold from this point, because the entire money making in the market will depend on whether we are moving towards stagflation and how strong this stagflation is. So I've been saying stagflation, stagflation, stagflation. So let me quickly explain what stagflation is. So basically, stagflation is an economic concept. It's a combination of three specific things. One is that it needs to have high inflation. Now, if high inflation is added on to high unemployment that is persisting in the economy, plus you couple low growth in the economy, that the GDP is not growing, then all these three conditions mixed give rise to a condition called as stagflation. This is a very worrisome sign. The world last witnessed stagflation in 1970s, and it was a hugely problematic scenario for the world. The world did not grow for almost a decade, and the world truly started growing from 1990s onwards. So the world had a very low growth phase from roughly mid 1970s to late 1980s. The culprit was stagflation. Now the concerns are that we are moving towards this stagflation. So for that, let us look at the data. So first and foremost, let us quickly look at the inflation numbers, and let's start with India. And we all know that inflation in India has also been quite aggressive, and it has been aggressive everywhere. So let us look at inflation data both from India and the US. So in India, the situation is like this, that right now we are hitting numbers around 7%. Going forward, it is expected that inflation is in fact going to rise to somewhere around 8% also. So here is a chart for the US. In the US, the inflation data is even scarier. There the inflation is roughly 8.5%. So the first condition of stagflation is met, that hey, the world is witnessing high inflation in India also, in the US also, and all across the globe. So I think all of us can agree that the first condition of stagflation is met. Now let's move on to analyzing the second condition, which is around the unemployment rate and how many people are getting employed in the economy. Now for this, I will just use the US data. Why? Because in India, the economy is mostly unorganized, so we don't get clean employment data. It is very difficult to ascertain how many people are getting employed in India versus not, because everyone will keep on giving opinions that Akshat, you know what, Zomato fired X number of people, or this Falana Deemka startup fired like Y number of people. So therefore unemployment is high or unemployment is low. No, we can't say that. We need to take a look at the macro data. So that is available in the US. So let us quickly take a look at this. So this is the US unemployment rate, not employment, unemployment rate, that how many people were unemployed. So very obvious that hey, in 2020 COVID situation hit, a lot of people lost their employment, and as a result the unemployment spiked up. Post 2020, the situation has been improving. Therefore, this unemployment rate is coming down. And right now, it stands at roughly 5.5 to 6% in the US. Is that a good figure? Is that a bad figure? Well, it is not a very promising figure. It is definitely not a healthy figure. It is not really horrible, but at the same time, it is not good. It can be considered somewhere in the middle. Why? Because this figure existed almost 6-7 years back. So from an employment point of view also, the world is not doing well. US acts as a barometer for the unemployment market all across the globe because it's a primary economy in the world. So if we take a look at US data, it kind of speaks for the data all across the globe. So this is the second key point. Third and final data, in order to assess whether we are in stagflation or not, let's look at the growth data, which can be indicated by the GDP data and GDP forecasted data. So here first take a look at the US data. Now here the growth rate was 5.97% and it has been coming down, and it is forecasted that over the next few years it is going to slow down and taper off. You will say, Akshat, this looks like really weird because here I'm seeing minus 3.4. Previously it was like 1%, 2%, 3%, and suddenly 5.97%. Why? Because we are taking the change in rate, and therefore you see a sudden spike, and there was a lot of money printing also, which accelerated growth, a bunch of other stuff. But to cut the long story short here, the US growth data also does not paint a great picture. What about India's growth prospect? Because it's an emerging economy. Is the growth prospect in India intact, and is it going to grow? Okay, so again the same scenario, unfortunately, that India's growth prospect also are not very high. For example, if you take a look at this data, this is not even inflation adjusted growth, which is not a very nice sign. So three conditions we talked about. So take a look at this particular graphic. The inflation is super high, unemployment situation somewhere in the middle. Third and finally, economic growth data not very encouraging. So it looks like that we are in the early stages of stagflation. So now your natural question will come that Akshat, you have scared us. So what is going to happen next? Can you talk a little bit about it? Yes, happy to talk about it. And the most sensible thing to do here is to study the 1970s stagflation situation. And there were two critical outcomes out of it. So the first was that stagflation situation was made worse due to central bankers. It was the President Nixon's government in the US, and central bankers kept on experimenting with more currency printing, currency extraction, this, that. Because around 1971, US decided to move away from the gold standard and gave central bank the mandate. Jitne print karne karo, right? We don't care. Just print money and extract growth. So central bankers also became Singham. They also said that, you know what? Okay, I'm going to print like money like a crazy person. Hell with the world, right? So they started printing money and they started running a series of experiments which did not go well. What is happening this time around? Same thing, I would say, that central bankers are not acting very responsibly. I'm laughing, but it's actually a very serious matter and I don't know what to say to that. But yeah, that's a fact. Let's move on to second point, that hey, the stagflation situation in the 1970s was induced because of supply chain shocks. And it was made worse because in 1973-74, there were oil embargoes which emanated. So the word of the day today is emanated, which emanated due to OPEC countries. So the oil prices jacked up. So the world witnessed a stagflation situation. This time around, again, we have a supply chain shock. So yeah, again, scary situation. I told you that this video is not going to be nice from that perspective. So should we get scared? And what is it that we should be doing as investors? Let us have a very quick conversation about it. And there are a few critical points that I'm going to leave you with. First and foremost, I don't think that the stagflation situation this time around is as aggressive as it was back in the 1970s when the world took almost a decade and a half to come out of that situation. So those kind of circumstances are not there yet. Why am I saying it? Because we have gone through coronavirus, we have gone through the supply chain shock already, and still we are not into that full-fledged stagflation situation yet. Going forward, I am hopeful that the world will be able to bounce from it. Number 2 point is that the growth in the world is going to slow down, and you and I as stock market investors are not going to make crazy amount of money in the next 2 years. So please don't expect fireworks to happen for the next 1 to 2 years. If your portfolio is somewhere around those sensible levels, stick with it. It's fine. Not the end of the world. Should you stop investing? Absolutely not. Please do not stop investing, because we don't know when that next layer of growth might come into the world. It might happen in 3 months only. I can be terribly wrong about this forecast, but once the growth kicks in, you will not have the opportunity to jump back on that growth wagon. Point number 3, can we move towards a full-blown stagflation? The answer is we might. It really depends on a lot of factors. Imagine the world to be sitting on a keg of explosive, and if some crazy nation, China for example, decides to eat like 100 monkeys this time and spread some new virus across the world, then yeah, we can't do anything about it. I think that will be like a horrible situation. The world does not have enough firepower left to deal with another major crisis at this point. So we seriously are sitting on a keg of explosives. Fourth and finally, what should you be doing as a stock market investor? This is not a buy on rise type of a market. Please don't try to do momentum investing. That will not work in such a market. What you should do is that please buy on dips. That is when you should be buying. For example, right now, the US stock market has fallen quite aggressively. I will come out with a specific video on another 2-3 days. What US stocks can you potentially consider buying? I'll make a video on that. It could be a good situation to buy. Please don't invest crazy amount of money in a rising market at this juncture. Please only try to buy things at support. What is a support? Support is a point. So I'm just drawing it here where the Nifty touches and it bounces back, or S&P touches and bounces back. So that is a support point. That is where you should be doing bulk of your buying. So that's it from my side. I hope you enjoyed the video. I hope you're not scared with this entire situation. Yes, markets are very volatile. We can have 2 approaches. We can become ostrich and put our head in the sand and just assume everything is hunky-dory, or we can actually look at the facts, data, and realign our approach. I'm still very much bullish about the world. My long-term perspective on the world is bullish. I still feel that in the next 1 decade or so, we will see very impressive growth. But you will participate and make money from this growth only when you have the courage to invest in these type of markets also. I hope you enjoyed the video. I will see you tomorrow.